Welcome to the HC Insider Podcast. I'm Paul Chapman. Today I'm joined by Colin Bryce. Colin is a founding partner of Energex, a natural resources and energy consultancy, and the former co-global head of Commodities for Morgan Stanley, as well as being chair of Morgan Stanley's International Bank. Colin's joining us for 2 episodes to talk about commodities trading. Firstly, what is a trading business? How should they be structured and organized? And what are some of the challenges and pitfalls in creating one? In part 2, we move on to traders themselves. What are the attributes and behaviors that makes a good trader? And what are the external factors around a trader that can lead to success? And we talk on career paths and career choices that can affect traders' success. Colin, thanks very much for joining us.
Thank you very much, and thank you for that very kind introduction. Appreciated.
I guess you've been involved in building, running, trading businesses across commodities for much of your career. And Energex itself is very much focused on working with producers around the world, building or looking at optimizing their trading platforms. I wanted to start with quite a simple question. What actually is a trading business? Because I think there's quite a few misconceptions out there. There's quite a few myths. What is a trading business?
Yeah, well, I've spent 40 years of my career, I guess about half of it being a trader and the other half managing, leading, trading entities. So I've kind of seen it from both sides. But, the simplest questions like the one you've just asked me are always the hardest to answer. So let's have a go and think about it from first principle. So trading is definitely a contested word. It's an emotive word as well, particularly when used by the press and the media. And it's a very misunderstood word, actually, both by folks in the general public, but also by professionals, folks in the energy business and in senior positions. When I can well remember back in my early days when I was a young trading assistant, the upstream chaps in the company I was working for talked of us as the folks who got rid of it. As if we were only good for getting rid of the oil that these wonderful scientists and people had managed to extract. And that was always the kind of sense, and it's clearly not the case. It underestimated, even in these days, the role of the trader. So trading is buying and selling at the market interface, I think. So you've got a spatial definition there, i.e. the market interface, a place where it happens, and you've got a functional definition, buying and selling. Perhaps you could add exchanging, whatever, to that. But that wouldn't really, I think, be quite sufficient, because I think you need a purpose as well, because trading takes place for a number of different purposes across a spectrum. And so at one end of the spectrum, you have what would be called hedging. So the management of risk inherent in a company's natural position, the risk manager role. And then at the other end of the spectrum, you've got what's known as speculation, which is kind of profiting from the risks inherent in the market, the risk-taking side of things. However, the risk takers, of course, are also folks who own the risk that they take and therefore manage the risk that they take. So actually at both ends of the spectrum, you have risk managers, whether they're risk managers as hedgers or risk managers as speculators. Important that we differentiate speculation as well from gambling. Speculation, as we've talked about, is profiting from risks inherent in the market, and gambling, on the other hand, is where you create new risks to try to profit. So very, very different circumstances. So maybe to kind of summarize what trading is and what trading businesses do, you would say that it's buying and selling to manage risk at the market interface.
Just to be clear on that speculation side, I think it was a fascinating and one of the most succinct descriptions I've ever had on trading. Are there people in the commodities markets who also gamble, or do you define everyone as a speculator?
Oh no, there are clearly people who gamble. I mean, I think the concept of outguessing the market certainly back in the day was something which was pretty commonplace. People speculated without really paying a great deal of attention to assessing data and, looking at to their competitive advantage are all the good things about effective speculation. But that sort of outguessing the market stuff doesn't work in the long run. And, there are less and less folks now in the marketplace that have survived that do that. And, it's not really present to the same extent as it once was, in my view, anyway.
Yeah. So you've got this, as you described it, a spectrum of hedging through the speculation in terms of what the goal is of the traders themselves. Can you just, I guess, help us navigate what can a trading business bring to an an oil producer, for example? What are the, I guess, different categories of value that it can return to the business?
As I think is public information, $2-3 billion of revenue to the VTOLs and the BPs and the banks in the past and the traffies, et cetera. I mean, it can bring a lot of added value to a business. But I think if we expand a bit, it all depends on the objectives, really, as to what it can do for a business. So if your objective's managing risk at that end of the spectrum, then you're helping to stabilize your earnings profile and you're locking in known returns, which helps you to access funding at financing at attractive rates. You're giving effect to your competitive advantage that you might have, and so you're engaging in prudent business management, and that reduces the costs of doing business, and it enables you to run your business in a more effective and stable manner. That's obviously very positive. If you're in the middle of the spectrum, which is where you have a combination, if you like, of managing inherent risks and taking advantage of opportunities in the market, given your natural position, maybe refineries or storage assets or contractual undertakings that you have, then you're doing what's often called asset optimization, mining the optionality, if you like, in your position. It's the BP VTOL traffic thing, and it used to be the thing that the banks did. It's where the money is these days and where folks are gravitating towards. And so, that's clearly a highly profitable area for people who have the right credentials, if you like, to operate. Difficult, but very rewarding. And then at the other end, at the speculation end, that would mainly be the hedge funds and the algos and people who are manipulating the data effectively. Perhaps they have some size advantages. They need a competitive advantage of some sort at that end of the market, as you do everywhere, to be successful. But these would be the three sort of areas where the function and the operational model can benefit the trading business very significantly, potentially.
I guess we've heard a lot about energy transition and some of the, I guess, ongoing change in the marketplace. Is, in simple terms, a trading business helps you, I guess, capture margin, but also navigate and perhaps even foresee some of those changes a bit earlier than if you didn't have that kind of capability?
Yes, I mean, you see the market and you have to be in the market to see the market. And especially these days in fast markets, you can no longer go out for lunch or close your book at 5 o'clock, as folks used to do, because, the market moves and is open and you need a feel for it at all times. But yeah, I mean, and as you talk to counterparts and you feel trends that are taking place, then it helps you move your business from perhaps one particular point in that spectrum gently to another point, just as I think in practice, a lot of businesses have gravitated to the middle of that spectrum from a functional perspective, as they've seen that is where the revenue, best revenue possibilities have tended to lie most recently.
So there have also been, over the last 20 years, a lot of different types of entities in building and engaging in commodity trading platforms. It started off, I guess, you had the oil majors on the oil side and some of the nascent trading houses, but you've had utilities in gas and power. And then you had the entrance of the banks, building trading businesses alongside their IBs. business. You've obviously had hedge funds. I guess, how does the owning entity impact the goals of a trading business and some of the constraints as well?
It used to be that the traders, in the kind of loosest sense of the word, were at the speculative end of affairs, and the oil companies at the hedging end, and the corporates up that end as well, and the banks, and then laterally likes of BP, Vitol, Traffic, Glencore, etc. in the middle where the money is. It all is a little bit of a question of, I think, the culture of the entity, the risk appetite of the entity, the sort of knowledge and experience base of the executives within the entity, how core the business of trading is to the entity. All these things, these objectives, competitive advantage related things, vary and differ by entity type, and that determines really where they will be on the spectrum of opportunity, really.
Yeah, there is certainly some idiosyncrasies to the actual business itself as to where they kind of started off and ended up, right? And you can see that just amongst the oil majors. I guess key to that decision, whatever entity it is, they are making a conscious decision where to place their business on that risk-reward spectrum, if you'd like. How have you seen leaders go about thinking about that, and kind of what influences those types of decisions?
So I think this is where, in Energex, we've been able to help people, and where I think it's money well spent for people, because it's the most difficult piece. It's trying to put together, the whole picture of, what's the culture of this firm, what are the objectives that we're aiming for in being in the marketplace, what's our competitive advantage in the market, do management understand well how to operate in markets and how to manage traders? Do you have the right good people in place, the right risk appetite? Do you have the control culture that you need in place? All these different, conditional probabilities have to be covered, really, and that's the difficult piece. That's the art of getting the whole thing put together. And there are lots of failures, for sure. You hear about the few hedge funds that do very well. You don't hear about the hundreds that fall by the wayside. And similarly, you hear about a couple of individuals who have great track records and presence, and are pumped up in the media, but you don't again hear about the scores of people that just don't make it. And it's difficult, and it requires a lot of intellect and good sense and managing these conditional probabilities to make it work.
Yeah, there's definitely confirmation bias out there, I think, as you hear the success stories. But also on the flip side, we've been involved in being upstream of discussions around whether, from the talent perspective, about, how and should you build a trading business. There's a lot of examples where it hasn't gone well. The results might have been great, but, there's been regulatory issues, or there's been, it introduces naturally a lot of risk into the business as well. And I really think that's the crux of this discussion is you've got this, it brings significant value to an organization almost this year at the existential level, when you've seen the results of the trading businesses for these oil majors in a time of dramatic price reductions in their core product. But it does introduce risk. And I guess it's the objective of the people who build these businesses and the leaders in them to try and mitigate those. Can you guide us through what are the major, I guess, risks or issues where things have gone awry? Can you sort of give us some categorizations into sort of where those have fallen and what businesses can do to mitigate it without obviously a bit of free consultancy?
There are lots and lots and lots of things go wrong, lots of conditional probabilities, which actually, I guess, represent the barriers to entry to the business at the end of the day. You might laugh, but I kind of compare it a little bit to breeding racehorses, which my wife and I do on the side. There are so many conditional probabilities between the time you get the mare covered, and you have a pregnancy, and you hope that the foal survives that, and then you hope that it's birthed well and it's got straight legs and it doesn't kill itself in the field before you send it to a trainer, and its ear passages are open, and it's fast, and a whole host of different things can go wrong. So very few actually, go from the point of conception to the point of being, excellent athletes. And it's exactly the same in the trading world. And what you do in the racehorse breeding world is you try to manage these conditional probabilities as best you can. You get a good vet, you send the horse to a good trainer, you give it the best of care and attention as it's growing up. You make sure your mare's very good, well pedigreed mare, etc., etc. So if you apply that then to the markets, the energy markets we're talking about, well, you've got the black swan stuff out there, possibly, the leptokurtosis, I think they call it, stuff that comes from left field, beyond the bounds of human rationality. The hardest bit to control. And actually it's not as rare as, as you think.
Apparently not.
I think it was it maybe Henry Ford that said history's bunk or something. I think he said history is bunk. Well, it's not. It keeps repeating itself in this sense. And, you keep getting these random black swan, left field kind of shocks. That's the least controllable piece, actually, of all the things that can go wrong. So what else? Well, systems, very important. Firms have to have systems to monitor market risk, credit risk, and monitor the activities and behavior of people. You need to have effective limit structures in place, which often are not adhered to. And, you need to have management, again, understanding the business and having it as a core business. You need to have a reward structure which rewards the right behavior, doesn't reward bad behavior. You need to have a culture where you don't have management by fear, which encourages people to put tickets in the drawer and hide trades for, fear of being castigated by or sacked by some disapproving manager. Sorting these things out ex ante is what you have to do. There's no point in charging headlong into the business and then finding you're going to face all these issues and trying to play to catch up and put your systems in place ex post because somebody's hidden some tickets in the drawer and you're facing a massive loss. Get all these things sorted ex ante. That's the best protection and the best way to manage the conditional probabilities that were just all too common and too difficult actually to work with.
None of that's cheap, right? Particularly setting up the systems. It seems as well that there also needs to be an understanding and a buy-in and a trust at the at the group level, at the board level as well. Because these can often be quite challenging to the existing organization's culture and setup. I think about, you mentioned compensation. Typically when you're building a trading business, that's one of the key sticking points when you have to introduce an entirely different reward system for a division of your business that brings with it a lot of challenges. Do you see that as well? How important is kind of the broader organization's buy-in?
Oh, it's terribly important, and it's extremely important that firms can cross that line, understanding that a certain type of reward system is needed for a certain type of activity. You have to reward rainmakers. You certainly don't have to reward coat tailors, which has I think what's brought the whole bonus culture into disrepute is that everybody has climbed onto the bandwagon, and that's not right, actually. But yeah, the big firms that have been able to get that bit right have been the ones that have prospered, none more so in my view anyway than BP over the years. And I guess you could include Shell and Total probably amongst the biggies in that category too. But these guys have managed to understand that this is a specific type of business with a specific need for specific reward structures, and have honed and fine-tuned these over the years to encourage people to do what they need to do to make the company successful.
Talking of those types of organizations, and I guess this is where that kind of transfer pricing comes in. There has always been a challenge, to my mind, of organizations trying to understand what is, I guess, beta and what is alpha. What is the system itself, the asset value chain that an organization has that is generating trading returns versus what the actual skill and capability the trader brings to that, and how do you balance rewarding those two things? That's definitely been a dynamic over the years that organizations have kind of gone back and forth on. Can you talk to that a little bit?
Yes, well, the value of the seat is a terribly difficult and very important thing to understand. And, if you have a little bit of history of a few different folks going through the seat, you perhaps start to be able to triangulate into what the value of the seat, the intrinsic value is, if you like. But, then determining, what of the rest is due to the company's credit position, the company's profile in the market, the natural assets and positioning that they have, and what's due to the real skills of the individual. It's a very difficult thing, which is why, certainly from my perspective, I believe that reward systems should reward consistent performance over time. I mean, I was never in favour at places I worked when I was rewarding people of rewarding one-off big years, because you just didn't really know whether that person had done it because they were lucky or because they had benefited hugely from the specific assets and the natural position that their firm had in that particular market setting, or whether they were just brilliant. But you could tell over 3 or 4 or 5 years, by the consistency of how they operated, whether they were, worthy of getting better paid because they were actually very, very good. And actually, in my view, there are not many people out there, not many traders who are very, very, very good. It's a high art, in my view.
There's a fair amount of fooled by randomness, to quote Nassim Taleb. And what's interesting about that is actually, in the wake of the kind of unintended consequence of the global financial crisis, was many organizations, particularly banks, moved to deferred compensation models with clawbacks. And that actually itself then rolled into some of the oil majors and so forth. And I think that did have a cooling effect and an impact on kind of the velocity of traders moving around. And, obviously because the good ones got more and more locked in each year. But also, did put a bigger lens on consistent performance. And I think you did find quite a number of individuals, whose track records, were looked at in the long view as opposed to those one-off spectacular years, and were perhaps it was a bit of an eye opener.
Yes, there's no question about that. It doesn't help when the media and publications pick up on, big stories of big profits that maybe someone has made, and they glamorize an individual, or they glamorize, an activity without really understanding what's behind it. It doesn't help. Prudent, conservative management of businesses. But yes, certainly, some of these things that have come to pass with deferrals and clawbacks and all of that kind of thing have moderated behaviour and are just part and parcel of the reward system, encouraging the right type of behaviour and not encouraging bad behaviour.
Well, if I look at the sort of the most successful organizations over the long term, you've mentioned a few of them. Most of them, in fact, all of them, have some kind of, enterprise value reward as well, some kind of long-term incentive that, whether, through equity or other means, where actually, a significant portion of traders' bonuses are coming in the form of that equity or deferred compensation that I guess does promote the right behaviors, both over the long term, but also over actually, building sustainable businesses.
Well, the equity piece, I think, cuts both ways for me. I'm not entirely convinced about that, because you look back, and I've just finished rereading The Smartest Guys in the Room, the Enron book, and you can see the damaging effects of folks really focusing on just the one thing, i.e. the stock price, because of the equity they had at any cost from that example. And so it can cut both ways, really. If you're going to be rewarding people with equity, which in theory is an excellent way of doing things, it has to be combined with, a high degree of integrity and a strong moral compass, and et cetera, et cetera. Many of the things which arguably were not present in that particular entity.
Yeah. Well, and the other thing that we've seen as well over the long term is you had such rapid growth at some of these trading houses that there were periods when people's, bonuses as a result of their equity, the dividends were, bigger than their actual P&Ls. So it can get out of whack that way as well.
Yeah. Never happened to me.
I know.
Anyway, my P&L was never that big, so, it wouldn't have done.
So I guess we're in a, Energex are busy. We're busy. We had Roland Rechsteiner on a few episodes ago talking about energy transition as a key driver for businesses to build trading businesses or I guess reposition them on that risk reward spectrum we discussed. And those are oil majors, mining businesses, right across the natural resource world. We talked about some of the benefits that trading business brings. How is the opportunity changed? Because it's not been a stellar decade in the zeros. There's a lot of headwinds, a lot of consolidation. How has the opportunity changed as you look forward for the next 10 years? What are we seeing there that means that perhaps strengthening your trading business is the right way to go?
Well, certainly at the inception of some of these markets, you could characterize these markets in energy as immature, and that led to a certain type of opportunity. And clearly, over time, these markets have matured. People have become clued up, and it's more and more important, really, to be able to utilize technology which has become available over the course of the period that the trading business in energy has developed, and use technology to quicken the pace of your business, to enable you to more effectively utilize data, less human sales and marketing touch, if you like, and more science. Although we all know we know all about following the science and ignoring the human touch from recent events. More regulation, so folks are bounded and monitored more closely than they were in the perhaps fast and loose early days. So perhaps it's a less colourful milieu as well. But underlying it all, you have the same things that you have to look to, which is competitive advantage, objectives of your business, the corporate seriousness of purpose, the efficacy of your reward system, your controls, the getting the right people in place, because all of these things will apply and have not changed, irrespective of whether you're dealing with physical cargoes of oil as you were in the 80s and 90s, 1980s, 1990s primarily, or derivatives and futures and forwards as you were dealing with in the 1990s and subsequently, or assets as people are more inclined to deal with up to the present time, or indeed new markets, renewables and net zero carbon pathway markets like LNG that are coming into the prime focus these days.
Yeah, so you've got, I guess, technology reducing costs. Certainly there's been a maturation of the markets. There are fewer colourful characters, as you mentioned. I read your articles on the history of oil trading with great interest. And there's also these new products as well. There's a couple of, it's fascinating as well. There's obviously been commodities are a very global market. But arguably we're entering a period of perhaps more trade restrictions than previously. And, I guess that only increases, well, two things. Firstly, that means organizations need to secure their value chains. But also, I guess, adds uncertainty as well. in what were perhaps more, it was easier to get rid of the stuff, to quote your early bosses.
Yeah, so I think, there's greater degree of sophistication in every respect. I think a greater seriousness of purpose about the whole activity, and it's not a bad thing. It's becoming a more inverted commas respectable, considered kind of activity, and that's only a good thing, really.
I think one of the major challenges, looking at it from a talent perspective, is that there has been considerable consolidation over the last decade, and less investment in new talent. You've seen the smaller cohorts coming through the trader training programs at the oil majors, if any. There are fewer organizations that have been growing, building, and developing traders, and there's been fewer trading houses themselves, through that consolidation. So one of the challenges is that there are fewer individuals out there at the junior and mid-level experience available to participate in building these trading businesses. And there's only so much that technology can overcome that.
Yes, and working from home will not help that at all. It's all very well creating a state or operating in a steady state working from home, but you lose all the finesse of the human contact, and you lose the ability to train people and help them understand the mores and rules and culture that your business operates with, and all these softer but terribly important things. That's all lost by home working. And yes, the number of folks, being trained in a business are less than they were because of the consolidation, and talent pool shrinks. That's an area which you guys, of course, are specialists and experts in, and you can help the whole process, and I'm sure you do help the whole process by being able to, say to a candidate, look, here's the type of company you should be looking at because this is how they operate and this is how they behave. And by the way, here's the sort of things that you need to think about in terms of your own skills and your behavioral characteristics. And you can help ensure that it's a smaller group of people who are graduating into the stream, at least at a high quality, well prepared, eyes wide open cohort.
And I guess I want to come on to that in our next episode with you, talking about what makes a good trader, but also, to use a colloquialism, horses for courses as well. Individuals understanding the best environment for them. But well, it's been a really fascinating discussion. Thanks, Colin, very much for your insight. And look forward to continuing in part 2. Thank you for listening to the HC Insider podcast. To find out more about HC, go to hcinsider.global, where there's more news and content focused on the commodities markets.